Welcome to the Techno Fundamental Report for August 28th. Thomas Hobbes, philosopher from the 1600s, had some very definite opinions about society and economics. Thomas Hobbes' core idea is that to escape the state of nature, where life is solitary, poor, nasty, brutish, and short, individuals should enter into a social contract. This contract involves giving up some individual freedoms to a sovereign power, preferably an absolute monarch, in exchange for protection and order. He believed this was necessary to prevent chaos and to ensure social stability. Interesting concept. He's talking about not having a democratic government, but having a monarch. It's like a ship's captain. The ship's captain, if he decides to change course, he doesn't have to go to all the passengers, get approval. He just does it. Kings or monarchs, they don't have to go to a Congress or a parliament. They just get it done. So what Hobbes is basically saying is that democracies tend to have a problem where they just can't get anything done. But the state of nature, what that's all about is where he's saying that the masses or of the population of the country will always resort back to a state of nature, which means chaos. So they need a monarch to give them safety, meaning a military and a police force. But that's all they want. They don't want anything else. So the reason I'm bringing this up is that if you think about a corporation, especially a publicly traded corporation, the CEO is in a way kind of like a monarch. If he says we're going to do something, we're just going to do it. So corporations and governments, especially democratic governments, I like the concept where the CEO, if you get a bad monarch and there's civil war, and that means he's violating the contract. Therefore, they're going to overthrow him and get another monarch. But with the CEO of a corporation, if you don't like what he's doing, you just sell his stock. Jesse Livermore, the game taught me the game, and it didn't spare the rod while teaching. What we do is hard. This is not easy. Investing in stocks is a very difficult process, but you need to learn the game. And as you're learning it, it's going to probably hit you with a rod. Cut your losses quickly without hesitation. Don't waste time on what you might have done differently. The reason he's saying this is that you need to stay in the game. If you make a mistake and you just ignore it, you could really have possible damage to your portfolio. So you need to stay in the game. Here's a graph of U.S. home price history from 1890 to 2025. And as you can see, we are at all-time highs. Now, the way they're calculating this is it's an inflation-adjusted Case-Shiller home price index relative to the consumer price index. So housing has been far outperforming inflation. So it's getting kind of frothy. The Dow Jones Industrial Average from 1896 to 2016. Human innovation always trumps fear. So there's always going to be something that comes along that causes things to improve. New technologies, whatever. But you could pause your video player and look at some of these things, but it's a lot to cover. The psychology of money. The reason I wanted to bring this back up is that you have to be steeped in reality. Someone or something deeply immersed in, saturated with, or influenced by the practical truths and facts of the real world, rather than fantasy, idealism, or abstract thought. In other words, you got to be serious about this. Most public companies are duds and few do well, and a handful become extraordinary winners that account for the majority of the stock market returns. J.P. Morgan Asset Management once published the distribution of returns for the Russell 3000 Index, a big, broad collection of public companies since 1980. 40% of the Russell 3000 stock components lost at least 70% of their value and never recovered over this period. Effectively, all the index returns came from 7% of component companies that outperformed by at least 2 standard deviations. That's the kind of thing you'd expect from venture capital, but it's what's inside a boring diversified index. What he's saying here in this particular article is that you really need to think about concentrated investing versus just buying everything. But some people feel comfortable with that, but reality, meaning we're steeped in reality, reality is out of the 3,000 stocks, about 200 of them drove the train. So let's take a look at the market. NASDAQ continues in an uptrend. We're holding above the 25-day moving average. Everything looks fine. But I think it's important to note that the mid caps are breaking out to new highs. This is very important because it means the market's starting to broaden out. We're starting to see more opportunities versus just 7 stocks in the NASDAQ. Here's the small cap index. Look at this. Now this has happened before. We've been really frustrated with the small caps here, but small caps tend to be very interest rate sensitive, so this could be some sign that the Federal Reserve is going to cut rates. S&P 500 actually doing better than the NASDAQ now, hitting a new high. Looks very positive. So the primary trend continues to be up. S&P's in a primary uptrend. NASDAQ is in a primary uptrend. Why is this important? It's important because if the market's in an uptrend, you got about a 75% chance you're going to make money. However, if the market's in a downtrend, it's about a 75% chance you're going to lose money. So we are in an uptrend. Here's the aggression index. This is where I'm comparing in a ratio the NASDAQ composite with the consumer staples, things like ketchup, toothpaste, so forth. This is a very defensive group of stocks. You could use electric utilities in here, but it's a good indicator. It gives you an idea that the growth stocks, meaning the NASDAQ, is outperforming the defensive stuff, i.e., therefore, the aggression index. Looks good. Interest rates are stable. In fact, they're really starting to downtrend here. And on our indicator, which says interest rates have gone down 9.7% over the last 125 trading days, which is statistically meaningful. This is basically saying the Fed's going to cut rates. I think they're going to cut rates. Volatility index, the VIX, making a new low, a fresh low, definitely in a downtrend. This is good. That means that volatility and the fear index are in a positive way. Here's the new lows on the New York Stock Exchange, under control, no problem. We're in good shape with that particular indicator. So I did want to mention NVIDIA is getting ready to report earnings. I'm watching it right now to see what the reaction is like. But I just wanted to point out that the pattern on the stock is fairly positive. It's somewhat flattened out here, tried to kind of roll over. So if the earnings report goes well, now remember they're going to report revenues for the quarter, earnings for the quarter, but the most important thing they're going to announce is what they expect for the next quarter and for the balance of the year. It means forward guidance. If the forward guidance isn't good, that'll be bad. So if the forward guidance is good, it'll pop up here. If the forward guidance is bad, it's going to break down here. So we'll just have to see. It should be coming out at any minute. So keep your eyes open. Thank you very much. And if you have any questions, please let me know.